He is at the Mercatus Center and former president of the Federal Reserve Bank of Kansas City, the great Tom Hoenig, who had been warning about bad Fed policy since his time in 2010 when we started to see quantitative easing or the Fed ratcheting up money. Tom, good to see you. So tell us, where did the Fed go wrong that's driven inflation and now bank failures?
Well, thank you for having me, first of all. But let me start with the Fed actually went wrong more than a decade ago with the introduction of quantitative easing during a recovering economy, and that was 2010. And they kept interest rates very low, and they went through like 4 different episodes of so-called quantitative easing, where you just print tons of money to keep the economy moving forward, I guess, or accelerating. And they held that in place. And so then we did it again with the pandemic, and even before that we had asset inflation. With the pandemic, the government spent a lot of money, the Fed printed the money to fund the government, and so then we ended up finally with the breakout of both asset and very serious price inflation that we're still dealing with today. And one of the effects of a very sharp increase in interest rates, and this was like an increase by a factor of at least 20 times in less than a year, was that you raise these rates and it really does suppress asset values. The very assets you caused to increase, you now suppress. And that, of course, is on the bank's books. They have to take either unrealized losses or in some cases realized losses, and it begins to put pressure on their performance. And so that's the other side of inflation. That's the other side of high leverage that you've encouraged with very easy, low interest rates. And so we're suffering through it now.
Tom, I know Sean Duffy wants to jump on the disaster that was regulation, which you talked to the Wall Street Journal, Dodd-Frank, over the weekend about. But this is what keeps me up over the weekend. This is the blowout in the Fed balance sheet that you were talking about. So let's go over here. Ooh, it was so small back in 2006, about $850 billion. Here was the 2008 financial crisis, and then it starts to get bigger. Right. They never pull it back here, and then the disastrous blowout where it gets to $9 trillion, and it's actually ticking back up. So this is what I say about it, because the rich got richer. This is money printing. This is what I say. Will it ever get smaller, Tom Hoenig?
Well, those assets and that reserve balances probably will get maybe a little bit smaller. I doubt it, because if you do that, you're taking all this reserves out of the system, you're squeezing liquidity out of the system, you're going to create new problems. So they're kind of stuck. So what you will do over time is inflate yourself out of it. And that's what we're in the process of doing right now. Unfortunately, I'm worried that that's kind of the future for a while until those reserves and balance sheet look a little bit smaller relative to the total GDP, which we've been boosting with high inflation, and that's going to continue.
So, Tom, you saw this in the 1970s. You saw easy money. You let the good times roll. And then you saw the crash come. You saw the same thing then happen in 2010. That's why you were opposed to this quantitative easing or printing of money. So let's say you're the Fed chair right now. We have a decision coming up later this week. What does the Fed have to do to tackle inflation and these asset bubbles?
Well, there's only one way that I know of, and that is you have to bring inflation down, and you usually do that by raising interest rates. And the question is, have they raised them enough now that if they leave them there, that the economy will slow, or do you have to raise them more? And that'll be the debate coming this week. And I think it'll be a heavy debate, because on the other side of that will be, given the fragility of the financial system, we can't afford to raise rates anymore because banks will be harmed, will have greater losses. And so they're going to debate that. I don't know where it's going to come out. I think in the long run, they need to say, let's stay with the priority being get inflation back down so that we can now manage this economy. But I'm not sure. And if they do cut back on the interest rates, or they stop raising interest rates and then come back, then we risk repeating the decade of the 70s. Where you raise rates, lowered them, more inflation. You raise rates, lower them, still more inflation, until you have 14% inflation. And that's when Paul Volcker came in and gave us, brought us back to lower inflation, but at a very steep cost in terms of a recession, deep recession, during that period. So I'm afraid this is made by the earlier policies, and I don't have any easy escape mechanism for them at this time. It's now we have to suffer through it, I'm afraid.
You tried to warn them, Tom. You were a dissenter. You tried to tell them.
I was, and then the other part of this is even after the last one, and this, Sean, you had mentioned, I guess, and that is we left our capital rates, our capital levels in our banking system marginalized, therefore more difficult to absorb this shock, and we're learning that lesson now as well. And then the supervision, people are still worried about that. I think we need greater disclosure of supervisory findings earlier in the process so that then you don't have a sudden shock. People have the earlier you discover something, the more easily it is to correct before you have a crisis. And that's something they need to think about going forward.
Tom, out of time. I want to bring you back at some later point and talk about Dodd-Frank
Sure.
and risk-weighted capital and the impact that's had on this crisis. Always smart, and you called it 13 years ago, bad policy that we would come to rue the day. Thank you for joining us today on The Bottom Line.
Happy to be with you. Thank you for inviting me. Take care.
Tech and crypto, the best havens for investors right now. To the Floor Show. Joining me now with $5.3 billion in assets under management is our friend and been through a lot together, haven't we, Bob? Crossmark Global CIO Bob Dahl. Bob, the market looks for the moment like it's getting better at absorbing the bank crisis headlines, but what is your caution level hitting right now?
Well, we're not out of the woods, I don't think, Liz. You can't just rinse your hands off and say did and done. This is going to have a lot of waves to it. Having said that, as you've already summarized, when you get a lot of those tech stocks up 15, 20% in a week, and a lot of high-quality banks, if there are any, down 15 or 20, it begs, in my view, to do a little the opposite. So I've been trimming some tech and slowly and gingerly adding to some banks.
Okay, adding to some banks. That scares me. Can you say which ones right now?
Well, because I'm in the process, I can't, but I'll tell you, they're none of the names you mentioned, not trying to do a spec on some bank that's in trouble.
Okay.
Trying to do banks that have asset liability mixes that make sense, that are down and have good franchises. So higher quality ones are obviously down a lot less than some of the names you mentioned, but they're still down a bunch.
Also down today, the volatility index, the so-called fear index on Wall Street. VIX right now is trending down about 5% to 24.26. That leads me to the Federal Reserve. We are less than 72 hours away here. Wednesday, we hear the announcement. The meeting actually is 2 days. It starts tomorrow. But Wednesday, we will hear exactly what the Fed is expected to do with interest rates. What is your best guess right now?
So I think the consensus is emerging to be 25 basis points. That's where I am. I think if they don't do anything, Liz, they'll be signaling, one, we're done. And how can you be done when inflation's still 5-6%?
Yes.
And or two, maybe they know something I don't know, and that worries investors. So I think the safe bet is the 25 with lots of cautionary comments around that, given the financial crisis.
We've also seen the bond market, the treasuries, really gyrating depending on which day and which headlines are hitting the tape. Right now, we're looking at a 10-year yield of about 3.48%. You can see what they've done year to date. It's more to the right-hand side of the screen, folks, that you look and you see, oh my gosh, that drop in yields means that people rushed into what they perceive to be the safe haven, which is government treasuries. And the 2-year, obviously, 3.94%. So it's moved back up, but nowhere near where it was on February 28th. Bob, is that still a trade that you like to park at least some cash?
So there's no question the volatility in the bond market is rivaling 15 years ago in the height of the financial crisis, with 2 years going from, call it 5 to 4, and the 10-year treasury going from 4 to 3.5. I think tech is overdone on the upside. Bonds are a bit too. I want to own some bonds. 350 for 10 years, a whole lot more interesting than 150 a year ago. but I'd be picky on my price and wait for somewhat higher yields and lower prices.
Somewhat higher yields, but don't we have to have more confidence before we see that, and more rate hikes?
Yeah, certainly more confidence. I don't know out the curve whether more rate hikes will get us there, but I think that quick move from 4.25 at the high not that many weeks ago to 350 is a little quick and a little overdone. I'll wait for. I'll be picky and stingy.
Okay, I just want to quickly look, if we can, at the Dow leaders, because, when in doubt, which is what we saw the last half of 2022, people flooded into the Dow Jones Industrials because those were stable companies. We've got Caterpillar, Honeywell, Dow Inc., the chemical giant, Travelers, and Amgen as those 5 leaders. Do you like any large caps here?
Yeah, among the ones you mentioned, Dow, Amgen. I mean, look, that stock is down well over 25% from its recent high, and I don't know that their businesses have changed that much in that short a time frame. Yeah, the economy is going to be a little weaker in light of the financial crisis, but I think that stock at roughly 50 is worth taking a look at.
I'm checking, we want to keep an eye very closely on First Republic as we continue to see some real gyrations here, still down about 45%. Bob, I just fail to see, for at least some investors, why they would try and make any moves at this moment when we're still very much in a state of flux.
Yeah, agreed. We don't know the end game and how long it's going to last. And, for my clients, I'm not going to that name, but that name down so much is taken to repeat a lot of other names of much higher quality, balance sheet, not a mismatch, not centered in one area geographically,
right,
or from a sector standpoint. Those stocks, many of them from their recent highs, are down 15, 20, 25%. So whether it's the big money centers or some of the super regionals, I think they're worth a trade at a minimum.
Neither you nor I are on the inside of these discussions where apparently J.P. Morgan is leading this charge to quite frankly, really either prop up or save First Republic. What do you expect happens here? I mean, is this bank going to survive all of the gyrations? And I say that my mortgage is with First Republic. I know many people who bank with this bank. It's a terrific consumer bank. I've had no problems with them ever. I just wonder if it's going to need a new partner to acquire it.
It may very well be the case. Look, you and I can talk about the fundamentals till we're blue in the face, but there has to be confidence. And when you start losing confidence, selling begets selling. People move their deposits, and there's a run on the bank. And that's a bit of what's happened to FRC. And hopefully Jamie Dimon and others can find a way to patch this over.
Then that leads us back to the Federal Reserve, Bob, and Wednesday, of course, the news conference where he gets questioned. Jay Powell, the head of the Federal Reserve, gets the reporters just firing questions at him, will be in this hour on Wednesday. People argue that it's their fault, that it's the Federal Reserve keeping rates way too low for too long, and then raising them too quickly, and that caused dislocations in the bond market and messed up everything else.
There's no question the fastest rate rise in U.S. history has consequences. They typically, that is central banks, raise rates until something goes, I call it bump in the night. And we've gotten that bump in the night, and now the consequences fall over everybody, as it were.
Yeah. All right. Check the Dow up 289, S&P up 23. Still in the green here with the NASDAQ up 15. Bob, a pleasure to have your voice and your experience on any day, but particularly at a time like this. Thank you.
Thanks, Liz.
Our tech decided to switch out the Dow bug on the lower right part of the screen, and any moment now it will update to have First Republic so we can keep a constant, there it is, constant eye on it. We are waiting for some type of confirmation that J.P. Morgan, this report out of Wall Street Journal, that the J.P. Morgan coalition is going to come up with a second type of rescue. Now, 11 times, we are hearing that this has been halted 11 times throughout this session. That is the latest count. So it has been a very herky-jerky day of trading for this California-based regional bank. All right. So aside from that, and aside from waiting on this report about J.P. Morgan Chase CEO Jamie Dimon leading the second effort in 4 days to stabilize the regional bank, we do have this coming in from the FDIC. The FDIC is extending the deadline for bids to purchase the assets of the newly created Silicon Valley Bridge Bank. The extension will go to 8 p.m. Eastern on Friday, and they are extending the bid time for Silicon Valley Private Bank, which is a subsidiary of Silicon Valley's Bridge Bank, to Wednesday, 8 p.m. Eastern. They're waiting on bids. They say there is great interest, but yeah, we'll believe that when we see it. One thing we do know for sure, we know billions of dollars flowed out of SVB during the run on that bank Thursday, right? A week ago Thursday. But is money now flowing back in? Let's bring in Henrique Dubugras. He is co-CEO of Brex, a fintech company that works with major Silicon Valley companies from DoorDash to Airbnb. And Brex saw a huge influx of money last week from SVB depositors fleeing the drowning ship. Word is that you guys are now taking at least $200 million of that money and putting it back into the new bridge bank of SVB. Why are you doing that?
Yeah, first, thank you so much for having me, Liz.
Sure.
So just to be clear, we're putting $200 million of our own corporate cash, not the deposits that we've seen come in. And the reason for that is we truly believe in kind of like a diversified strategy of not only keeping your money in one bank or one place, but kind of spreading it out. And I do think that SVB is one of the safest places to park money right now. Therefore, we feel good about our $200 million and feel good about our customers kind of doing the same if they want to and believe to. And the second piece of it is I do think the Silicon Valley Bank was an important piece for tech. And I think like supporting them during this time so, they can have a better outcome is something important. So we definitely wanted to signal our support there.
Is it almost, and I don't mean to put any kind of words in your mouth, but a de facto bid? The fact is that the FDIC says non-official bank entities can bid for some of the assets of the Bridge Bank and the other parts of the bank that are still at least viable enough for bids. Are you making a bid? Do you have any intention of bidding on any of those assets?
I would say that, for us, we don't have any intention so far. And, maybe that can change this week. Until last week, it was only banks. Now I would say, we even have the opportunity, but I would say it's still a little bit large for us to make anything.
Okay, so we get that frightened regional bank customers were parking money in big banks, but yet they really flowed to you as well. What is it about Brex that you feel attracted that money?
Yeah, I feel there was a couple of things. So the first thing is Brex is not a bank, right? We have a business account product that's a cash management product. So what we can do is the number one thing is we can spread your money out to now 20 plus different banks and get over $5 million in FDIC insurance for your money. So that's something that I think before last week people didn't care much about, but now it's a big thing because they saw that even if Silicon Valley Bank, the FDIC insured piece of it was paid much faster. So diversifying across a variety of banks is something that we do, and I think that increased FDIC insurance is something that is very important for our customers now. Number two is the fact that we're not a bank. We allow them to spread their money in FDIC insurance, but also buy money market funds. So when you give your money to a bank, you are giving them the right to invest that money and buy the treasuries and lend that out. When you're in a cash management account like Brex or Fidelity is another example, you're choosing the amount of risk you want to take with your money. So you can buy and own the underlying assets of, for example, a money market fund, which we offer our customers.
Okay.
And number three is
go ahead. Yep.
We open accounts quicker than everyone else. So I think when others were taking a week to basically open an account, we were opening in an hour. So in that tumultuous time, that mattered a lot.
I would imagine. And clearly people know your product. And you're good enough for Airbnb and Grammarly and some of these other very established companies. You also have partners here, Lending Bank, Town Bank, J.P. Morgan Chase, East West Bank, Axos Bank. But here's my question to you. Silicon Valley Bank was arguably not necessarily a rival, but a competitor in some of the businesses. You guys had crossover when it came to certain parts of the business. Venture capitalist Peter Thiel is a backer of Brex. We know he had money at Silicon Valley Bank. We also know that the reports have said that Peter Thiel had encouraged a lot of the startups that he represents and that he has funded to pull their money out starting on March 19th because he was worried about Silicon Valley Bank's stability. So, you know, there are people who are looking at this saying, well, sure he did. He backs Brex. He probably told them to get out of SVB and put it into Brex. And that's how you got all of this money. What do you say to that? Can you give us a window into how that may have worked?
Yeah, so number one is Peter is an early investor of Brex, but never even talked to us about taking our money out of Silicon Valley Bank. So if he was saying that to other portfolio companies, may be true, but definitely not to us. Number two is I would say that there was every VC that I know in Silicon Valley was saying the same thing. It's hard to track who was the first, but I do think it was a widespread phenomenon across every single venture capitalist. It wasn't, started or by someone specifically. And I do think that for Brex, Silicon Valley Bank going under is honestly net negative, even though it may seem good from the outside, because obviously we have the short-term deposits coming in.
Right.
Customers not trusting anyone but the big banks with their money is terrible for us, right? So if the outcome of all of this is, hey, I can only trust my money on JP Morgan, Wells Fargo, that's terrible for Brex. That's terrible for Americans' banking system. That's terrible for all small community banks around the country, and it's terrible for the customers because banks like Silicon Valley Bank, for example, or even First Republic or business accounts like Brex, we're specialized in a certain set of customers, and we can give them much better service because of it. And customers not trusting their money with these banks anymore and service providers would be terrible for all of them.
You know what I've been saying from the start, Silicon Valley Bank was the bank of first and last resort for startups, and they always said yes when other banks said no, and they were very much a generator for the vibrant startup community, not just in Silicon Valley, but across the nation. But please come back, Henrique. We want to continue following Brex and see exactly how this story develops.
Thank you so much for having me.
Anytime. Chinese stocks amid all of the discussion about banks. We've got to look at some of these names. NetEase is flat, but it's pretty much a mixed picture here. We've got Baidu up 2.6%. Alibaba is down 1%. The real news that relates to this is that Chinese President Xi Jinping shook hands today with Russian President Vladimir Putin in his first visit to Moscow since the invasion of Ukraine. As the Russia-Ukraine war rages on, Chinese officials say Xi is making the three-day trip to the Kremlin to promote peace talks and to demonstrate Beijing's continued support of Russia. CTBC is Taiwan's largest private bank with branches across Hong Kong and China. We're bringing in CEO of CTBC Bank USA, Norman Nye. He also ran Charles Schwab Bank. He worked everywhere, Citibank, JP Morgan. And, of course, we're bringing in former UBS America's chairman and CEO, Robert Wolf of 32 Advisors. Robert, we'll get to it. It's really hard to pick which is, because we got big news on both of these. But I want to begin with you, Nor. As we watch the developments with Chinese leader Xi Jinping and Vladimir Putin of Russia, talk about how you see your bank and everything else that's moving in the financial world relate to what happens globally between those two nations.
Thank you for having me, Liz. I think that's a great question. The interconnections between Greater China and the U.S. economy, as well as the global economy, run very deep. So while we do obviously pay attention to the headlines, and from our catbird seat of actually watching those trade flows, the east-west trade flows, we're actually seeing very little contraction in those trade flows. So that this coupling at the sectorial level between the two economies continues unabated, which gives me reason to believe that while the political issues may still get debated for a bit longer, the economic ties still remain. There is a lot of talk and actual movement of onshoring and resiliency in moving some of these supply chains. But once again, from what we're seeing, there is enough of it moving to make the headlines, but the entirety of it is not moving to Vietnam or to North America or to other parts of the countries. It continues today to be the world's factory.
Indeed, but as we continue to watch the developments financially, your part of the CTBC Bank is focused very much and headquartered in Southern California. You have an opinion specifically saying that the Federal Reserve is facing a trilemma at the moment because we have so much upheaval with all of these banks, and we know what happened to Silicon Valley Bank, but how important are regional banks right now, the smaller community banks?
So just to add the detail on the trilemma, it used to be a couple of weeks ago that the Fed had three congruent goals, right?
Yeah.
There was fight inflation, maintain stability, and ensure and promote jobs and growth.
Sure.
Just last week, I think those congruent goals suddenly became mutually exclusive. So the one thing that now trumps the inflation and the job growth goal is financial stability, because financial stability is the underpinning of the global economy. And so I think that how it affects community banks, I think community banks play an incredibly important role that sometimes doesn't get talked about or brushed aside, which is that we're in small town USA. 90% of the job growth that happens in the United States happens through the formation of small businesses. And we're the ones serving those small businesses in those rural communities or even in the small towns where the big banks don't go. So the preservation of community banks is, I think, of ultimate importance in the efforts that are being made right now.
You talk about bank stability, and that's exactly what the Swiss National Bank, Robert, had to do over the weekend by forcing, I don't know, you could disagree with me, you worked at UBS, but forcing this marriage between UBS and Credit Suisse, which was floundering. Right now, Credit Suisse is down 52% at the moment. UBS was forced to enter this deal. They probably didn't want to, but give us your understanding of what happened here just to stabilize the situation.
Liz, thanks for having me on. Nor, nice to hear your insights. Listen, this is a great deal for UBS. They just, for the most part, now have a monopoly. It used to be a duopoly between CS and UBS in the private client space in Switzerland. And they just got that for $3 billion. They couldn't have bought it a year ago for $20 billion. And so two things. One, there was zero chance that anyone was going to buy CS other than someone domiciled in country. So UBS was the only option. Secondly, this is very different than the recent stuff done with Silicon Valley Bank and Signature Bank, because that was just about depositors. This is much more like Lehman during 2008, when JP Morgan, to take over Bear Stearns, had to get risk protection and liquidity. This is similar. The Swiss National Bank came in and are giving $9 billion of protection to UBS in this takeover, plus $100 billion of liquidity. So they wanted the deal done. They made sure it was a sweet deal for UBS. My guess is UBS is going to pick apart the investment bank and keep what they think is best in class, and they're probably going to retain a lot of the assets of private banks. This was a great deal for them.
You, having been on the inside at the New York Federal Reserve Bank of New York during the 2008 financial crisis, Robert, I do have to ask, okay, so Swiss National Bank helped ring fence this problem of Credit Suisse possibly completely imploding, and that would have been a much bigger deal, if I'm correct, than Silicon Valley Bank collapsing. But they ring fenced it with what? Steel or bamboo? I mean, are we going to start seeing some wind blow through that and blow it down?
I don't think so. I think that you're going to have a disproportionate amount of their private clients stay. UBS is best in class in that private client space. The combination had over 30% of all deposits. UBS is going to be a safer bank today than it was 48 hours ago, because they're going to have a much stronger asset management and private client base, and they already had one of the best in the world. So I think that this is a smart play for the Swiss National Bank. CS was, excuse it, but they were dead man walking. They were toast. The minute Swiss National Bank said, I'm out, and the minute FEDMA had problems with their reporting, Those were two just nails in the coffin that they were not going to be able to deal with.
Yeah, it's just a little strange that it was done. This deal was done without shareholder vote. But let me bring it back to Noor. We talked about the New York Federal Reserve Bank, and then, of course, the role that the San Francisco Federal Reserve was supposed to play, and that is looking over at some of these banks and making sure of the overall stability here. I know you're an advisor there at the San Francisco Fed. Mary Daly's taking some incoming fire in the form of criticism about where was she? Did she not see that SVB was struggling?
So, Liz, let me just start off by saying that most of the advisory responsibilities I have are in strict confidence. But I can tell you, just in a general way and speaking in my own personal capacity, that I think Mary Daly is one of the best regulators that I've ever met in 45 years of banking across 3 continents. And some of the recent reporting that you're seeing coming out actually proves that the Fed was actually on its game, that for the last 2 years, they had been pointing out the very weaknesses that we saw lead to SVB's unfortunate demise. And in fact, in some of the regulatory speak, some of the methods and tools that they used were the equivalent of hitting a bank's board with a 2x4. An MRIA, a matter requiring immediate attention, bears with it great menace and great enforcement power. So this isn't the Fed doing administering glancing blows. These things are very explicit. They are backed up by not just very experienced staff, but lawyers as well. So to me, this focuses the conversation and attention right back at SVB's management and its board for a complete and utter lack of failure and irresponsible acts.
Noor and Robert, it is a fast-moving target that a lot of people are having trouble hitting. But Robert, thank you. Noor, it's great to have you on the show. We are coming right back. Charlie Gasparino in the chair. Don't go away.
Explore this in more detail with Peter Marisi, who too shares this idea that, Powell might have and the Fed might have brought us the very conundrum we're in right now. Then the question becomes, Peter, always good to have you. How do we get out of this?
Well, we get out of it with decisive action. The Fed all along has hesitated and done halfway measures. For example, the first they guaranteed the deposits at FVC and a few other SVB and a few other places when they need to do it for all the banks. And then they said they would guarantee the deposits for, systemically important banks. Well, the reality is we don't know who is systemically important until a bank has trouble, and then it causes a panic. So they need to basically guarantee all the deposits. That doesn't create, some sort of risk bias or moral hazard. And also what's going on in Europe is not helping. The Swiss regulators are behaving in an absolutely irresponsible manner towards bondholders, which is causing a bond panic over there.
No, you're quite right. I mean, those who held $17 billion worth of bonds all of a sudden had to take a back seat more to the stock investors, which is upside down. That's normally not the case. So they've been screwed over, pardon the French here, and or the Swiss. I'm just wondering where this goes because, if you think of what has been a trend in this country, Peter, a lot of people who are at regional banks, smaller banks, even though those banks have none of these problems that a Silicon Valley, that a Republic, or some of these others might have had, are in fact taking their money out, going to big money center banks. And those same big banks have been the ones acting as a backstop to First Republic and these others. So all of a sudden, they're kind of in on a potential contagion. What do you make of that?
Well, yes, by not guaranteeing their deposits, people are tempted on the West Coast, for example, to go to Bank of America. And in reality, what was SVB's sin? They bought long treasuries instead of shorter treasuries? I mean, that's absurd. The bondholders in Europe, they were buying the very bonds that regulators were pushing banks to issue to shore up their capital. So people were doing the kinds of things that regulators wanted them to do. Banks investing in Treasury securities rather than tricky stuff when they didn't have enough loan customers and so forth. And then at the first sign of trouble, they basically shut them down and create a crisis for depositors. Here's an interesting question in all this. They say it creates moral hazard if you put your money in the bank without checking its balance sheet. Should Grandma Moses, who might have more than $250,000 at age 66, in her retirement savings account, have to worry about, what's in the bank? That's just storing money. Also, General Motors, how do they provide for their payroll if they can't deposit money in banks with confidence? But, there they were vacillating all weekend about moral hazard, weekend before this, and about whether, this really was a systemic risk or not. What we've got here is a lawyer playing a banker in an economist job and a very uncreative Treasury Secretary. I mean, after all, name me 3 creative things that have come out of Janet Yellen's mouth over her long public career, especially at a time of crisis.
Well, I mean, she's done some good, right? I mean,
I'm trying to figure out what that is. That would be an interesting exam question. But, all along through this thing, they've hesitated, and then the crisis gets worse. And then they do the wrong thing, and it gets worse yet. And then they turn around and blame the banks, and the president comes out and says, I'm going to hold those people who've done this responsible. Well, he better start looking inside his administration.
Political, right? I mean, this has happened under Republican and Democratic administration, and our adherence and almost allegiance to the Fed as the ultimate Seuss, right?
Well, yes, and also what you've got here is a situation where there's too much focus on the financial sector. You raise the question as, does this shake up markets, if they raise interest rates? Well, if they do, it shakes up. If they don't raise interest rates. If they do that, it calms financial markets. But what does it do to the people in the real economy? It tells us it's the 1970s all over again, and that we're going to put our foot on the brake with regard to inflation for a period of time, and then let all hell break loose again at the first sign of trouble. So that means if you're Procter & Gamble or the corner drugstore, you have to build inflation at 5, 6, 7, even higher percentage points into your business model long term. It totally defeats the efforts they've taken so far.
All right, that is if they pause this week. We'll watch very, very closely. Peter, great seeing you again. Peter Marisi,